Earlier, we had mentioned asset allocation is linked to life cycle stages and financial goals. Let us explore the various life cycle stages for an individual. Childhood stage, the first stage. The individual is dependent on parents. Young investor. At this stage, the primary objective should be wealth accumulation. With 30 plus years left for retirement, the portfolio can withstand volatility. Young couple in mid-30s. At this stage, the individual has multiple goals, including kids' education, financing a house, and kids' marriage. The portfolio needs to be balanced with investment serving these multiple objectives of capital growth, capital preservation, and augmenting income. Equity would dominate the portfolio with addition of fixed income assets to balance the portfolio. Mature couple with grown-up children. At this stage, 10 to 15 years are left to retirement. The investor or individual has accumulated some wealth. There are dual objectives. One, to fund higher education for kids, and secondly, to plan for retirement. Capital preservation becomes an important criterion. The individual seeks to accumulate as much wealth without sacrificing the goal of capital preservation. Risk-taking ability becomes limited at this stage. Retired couple. Income generation is the primary criterion. They don't mind little investment in equity for capital growth, but primary objective is stable income. Stable income is generated by investing in fixed income securities. Investor is also concerned about liquidity in the portfolio to meet their needs. Asset allocation can be implemented via different strategies. Strategic allocation is one such strategy. Strategic allocation keeps in mind long-term needs of the individual. It involves a targeted proportional allocation and periodic rebalancing to arrive at the desired asset allocation. In this example, portfolio has been designed with equal weightage of 50-50 to equity and debt. If equity decreased over a certain period, the original allocation will be restored by selling debt and buying equity. Strategic allocation can underperform during a bull run. Tactical asset allocation. Tactical asset allocation adds or reduces allocation to assets based on a view. For example, if the economy is going through a growth phase and markets are supposed to perform well, then allocation to equity can be increased. In tactical asset allocation, the advisor actively manages the portfolio with the aim of adding value through short-term adjustments based on view on performance of the asset class. A product provider like mutual fund might also increase or decrease allocation to a certain asset in a tactical asset allocation strategy. Tactical asset allocation can come under stress during market crash. Tactical asset allocation adds or reduces allocation to assets based on a view.